Hi, this is Steve Hutchinson with Hutchinson Family Offices, and this is our August video update. And we've got a lot of information I want to cover in this particular segment, and I want to kind of elaborate a little bit more on some opportunities that we see that are moving post-COVID, if you will, and kind of adapting to some of the strategies that we feel that are really looking good for our economy and for investors. First thing, I want to give a big shout out to Sherry McWhorter and her team. They always do our videos, and if you notice, they're very high quality, and they beat me doing on a iPhone, and I just love their work. It's a great production when they come in here to do this. I also want to thank all of you that showed up for our event just a few weeks ago in July. And it was a very successful event. We were a little skeptical as to how many people would really show up post-COVID. We had a good turnout. We had a lot of folks there. Bob Bourne with Bourne Financial Group spent a lot of time going over the various programs, the new properties that they're taking a look at. And folks got to ask a lot of questions. We had some social time. So it was great to see everyone there, and we were very positive about the result of it. So hopefully we'll have another one here, maybe post early next year. One thing we do have coming up is our annual client event. Now, we didn't have one last year, for obvious reasons. So this year, the team has selected Havana Nights. Okay, take it wherever you want to go with it. Havana Nights, it's on October the 15th, and we're going to be having it at the Sedgefield Country Club, and we're going to have a great time. We're going to have some music. I think we're going to have some casino games, and of course with Havana, I would imagine we're having a few cigars too. And I also want to remind you that if you have not downloaded the app, so you can check on your accounts, email your team, keep posted on what we're doing, our videos, and various and sundry activities. Download that, and it's an excellent item, and I think you'll enjoy it. So let's go right into this month's video. I always like to start off with the labor report. And the labor report for July, which was just reported about a week ago, at the filming of this about a week ago, showed very good job gains. About 943,000 jobs were created in the month of July, which is a great number. 250,000 of those jobs were teachers and educators going back to work. So adjusted, though, even for that number that comes up every year, you have teachers leaving work and then coming back to work, we see a significant gain in jobs, and it does look good. Now, most of the jobs were in the hospitality and leisure area. So, restaurants opening up, people getting out traveling, we're starting to see that. Now, this may be tempered at some point in the future as we're continuing to deal with this virus. It's plagued our country for at least a year or more. And quite frankly, until we get a handle on that and we start to feel like we're getting good responses from the procedures and vaccinations and everything that's out there, some stuff remains a little bit up in the air, but we still feel overall pretty positive. Now, the labor market did show a nice decline in the unemployment rate, dropped a half a percentage point, can't argue about that. And the number of unemployed is currently at about 8.7 million. Now, that's still pretty high, and about 3.5 million of those folks are considered what we call long-term unemployed. And we got a ways to go to get back to where we were. 2.9 million people are affected with permanent job loss. So we got a way to go to get to the 2020 numbers. But we are seeing some improvements. Now, a couple things that stood out to me in the employment report was the cost of wages. Wages are starting to move up. As the demand for employers, as the employees employers are finding themselves in a situation where they're going to have to start raising wages to attract quality people. So I think that for the most part, we'll see a little bit of inflation pressure from wage increases, and I'll discuss that a little bit later in this video. But bottom line is we are seeing good labor results post-pandemic. The financial markets overall, July was a solid month. We saw a lot of solid earnings. We saw the S&P 500 come in with a really nice earnings ratio as far as earnings growth. And we feel very comfortable about the companies that we have in our clients' portfolios, in your portfolio. To be very straight up, there are some trends that we're spotting now, and I'm going to elaborate on that a little bit more later. But we still see we are very, very strong in senior housing. We believe that's a demographic play. As the baby boomer generation continues to age out, they're looking to change their patterns. And I believe that this is being accentuated by the fact that we're having such a strong real estate market. You think about it, your homes have now, in many parts of the country, have achieved a value that you've never seen. So, there's an old saying, you won't ever go broke taking a profit. Well, the problem is if you sell and you buy somewhere else, if it's a good time to sell, it's not a good time to buy, and because all ships go up and down with that tide. But bottom line is we're starting to see the demand for senior housing really start to pick up. A lot of private equity is starting to move into that sector, and we believe for the next year or two that's going to be a very strong investment. We are particularly excited about the independent living properties. We're very excited about apartment complexes that are age-based, 55 plus. Those are the areas that we feel offer the greatest opportunity, at least in the short run. Of course, we're going to see improvement in valuations on memory care and assisted living, but those two first sectors really have our attention. The other thing that we are seeing right now in the earnings, and we're hearing a lot about this out in Washington, is the electrification of cars. Now, I think I alluded to in a previous video that, in my family, we purchased a Tesla, and quite frankly, it was a function of economics. Lease runs out on the car. What do you do? Where do you go? My wife drives a lot. Quite frankly, she never leaves Guilford County, but I think she's got every square inch of it covered in her car. And so the bottom line is it costs us $40 a month for electricity, and I think she's putting on an average of about, don't mean to not busting her chops, but she's putting on about 1,200 to 1,500 miles a month, taking care of her parents and all this other stuff, so it adds up over a period of time. But the electrification of cars is very interesting. I believe that this is a long-term trend that we'll see in the financial sector. I think we're going to see more and more companies looking, or more and more investors looking to invest into that sector. There are a few good pure plays right now, like owning companies like Tesla and a few other ones. There's been some other ones that have come on board, but they really don't have any cars. And our choices to buy electric cars are rather limited. I think really outside of Tesla and a Ford Mustang and maybe a Chevy Volt once in a while, there's really not a lot out there. But people are anticipating the opportunity to own an electric automobile. I'm hearing that more and more. Where I think the play is I think it's in lithium. There is not going to be a battery-operated car in this country or in Europe or in any part of the world is not going to need a lot of lithium. And that's what they make the batteries out of. Unfortunately, lithium supplies are a little tight. The ability to mine lithium is obviously geographically restricted. Here in North Carolina, we have some pretty good lithium mines. We got some good companies that are out there developing lithium mines and building. But every Tesla that you see riding around, or every future electric car, is going to have a really nice battery in there stocked full of lithium. So we're kind of looking at the lithium side of the sector rather than the manufacturing side. It's one thing to own Tesla, but it's another thing to be the guy supplying. No Tesla can go on the road without lithium. So we would rather be the person selling the batteries to those companies. The second area that we're seeing is in the housing market. we're just not seeing a softening in the housing market, which is very interesting. We've all been through these cycles up and down, but today, home prices are at peak levels. And yes, you can sell your home for a very nice price today, but where are you going to go? And that's what we keep hearing with people. Hey, I can sell my home for a lot more than what I paid for it, make a profit, but I don't know where I'm going to go. Rents are getting higher. If you sit down and take a good look at apartment rents, they're not backing off. And in fact, if anything, they're going higher because the demand is increasing. The availability of apartments is tightening up. We're seeing occupancy rates at the highest level in some time. So real estate, housing is really kind of a foundation of our economy. And I think as long as that particular sector stays strong, I think we're going to do really well in this country. So this is very positive right now. I think it feeds well into the demographic trends for senior housing, but I also believe that we're going to start seeing some positive impact throughout the economy. Now, we do see some market risks. As many of you know, we watch very carefully valuations on the companies that we put in your portfolio. Every one of those companies are monitored very closely on earnings. We do look at valuations extremely close. And they're getting a little stretched right now. Although we've seen some solid measures in the S&P, we've seen good 20% year-over-year growth in earnings. But when we get out to pricing it, we got the S&P 500 trading at a multiple of about 130. You put $130 per share. You put a multiple on that, whatever multiple you want to put onto it. It's really stretching valuations right now. So we're a little bit concerned about valuations. I think that it's reasonable that we would expect a pullback in the financial markets as people settle down, possibly as we move into the summer, which is kind of a let's go to the beach time of the year. A lot of activity on Wall Street. Earnings season is over. So for the most part, we still feel very positive about the market. We feel positive about the companies that are in your portfolio, and we monitor those consistently. The second thing that we see right now is the Fed, and I keep talking about the Fed. I always talk about the Fed because there's an old rule in investing, don't fight the Fed. If the Fed is tightening, the financial markets usually respond with a decline. If the Fed is loosening, the markets reciprocate with upward movement. Right now, the Fed is, I think, in a little bit of a quandary, although I think Chairman Powell knows exactly what direction he wants to go. But at every corner, he seems to be getting a few surprises now and then. This latest strain of COVID that's out there that seems to be causing a little bit more concern may affect his policy. But we think that, and we've been hearing this a lot, we think that we're going to start seeing the Federal Reserve taper. By that, we mean purchasing less bonds on the open market. Now, they still got an $8 trillion balance sheet they got to do something with. And if you go all the way back to 2008, when it really hit the fan, we only had about $1 trillion. So we have grown the Fed balance sheet from $1 trillion to $8 trillion in a very short period of time. How they unwind that remains to be seen. But maybe they don't unwind it. Maybe they keep it at that level. That's something we just are going to keep our eyes on. But the Fed does raise an issue. Now, one thing we will be talking about is government spending. As of the time I was doing this video, the Senate had just passed a $1 trillion plus infrastructure bill, which had about $600 billion of new spending, $550 to $600 billion of new spending, and which is fine. I mean, I'm not going to get into the politics of whether it's a good bill or a bad bill. It's what they did. We'll live with the consequences. But the bottom line is now they have turned to on a $3.5 trillion budget expansion. Now, that's a lot of money, folks. That is a heck of a lot of money. And that much money going into the economy is going to be inflationary at some point. More dollars chasing fewer goods and services. The hope is anytime you do this type of government spending is the economy will grow out of it. That remains to be seen. Will the $3.5 trillion budget get through the Senate unscathed? That remains to be seen as well. But we'll keep our eye on it. And again, politics aside, heavy spending by the government often has some long-term consequences. So we'll keep a look at that. Inflation. Is inflation transient? That's always the question right now. And I haven't heard, I can't name 10 people who used the word transient 2 years ago, okay? But now I guess there's enough media that is using that word transient and taper. And is inflation transient? On the wage front, I don't think so. I think wages, which are moving quite significantly, might be a little bit less transient. Will goods and services be transient as far as cost raising? I don't know. I think margins are going to be squeezed. And certainly if they raise taxes, if Congress raises taxes, margins are going to come under a lot of pressure. And so all this remains to be seen, but I'm not convinced at this particular point that inflation is as transient as we would like to think for it to be. I think we're going to have higher inflation. It's going to be here for maybe a year or two. It might be longer than that. We don't know for sure, but we're planning accordingly. Again, we're not hot on bonds. We don't believe that the return on bonds is worth the taxes and inflation. I looked at a bond portfolio that had about a 7 to 10 year maturity on it a couple of weeks ago. The yield to worst, which means like they're callable and stuff like that. These were high grade bonds. They had about a 2.5, 2.7% return. By the time you back out taxes, you back out inflation, and you know what it costs you to acquire those bonds, you ain't making any money. So bottom line is we're not a big fan of bonds. We just don't feel that investing in bonds at this particular time is good. Again, as we move further into the summer, I think we're going to see a lot of emphasis on housing. I think we're going to see a lot of emphasis on the electrification of vehicles. I think we're going to see some opportunities in there, and I think housing will continue to remain strong. Generally speaking, we're positive. We're not optimistic, but we're positive on the economy. We believe that what's in place now looks good. We don't know what, no one knows what Congress is going to do when it's in session. The old saying, no man, woman, or child is safe. But bottom line is we will deal with those circumstances when they come out and not worry about them in between. Worry is, I like to say, worry is a lot like a rocking chair. You get a lot of movement, but you don't go very far. So that'll do it for this month's video. Give us a call if you got some concerns, you want to discuss some of the ideas I presented here and how it might impact you. Give us a call. Talk to your advisor. Talk to me directly. And until next time, we'll see you.